Okay, good morning. It is 10 a.m. on Wednesday, October 1st. Happy October, everybody. Today is, again, our weekly webinar, and today's topic for our financial focus is going to be the retirement plan catch-up rules that are changing starting January 2026. This has been a long-awaited change. I'm going to talk a little bit about the history behind it and what it means maybe for you, but it's going to affect a lot of Americans. And we'll talk more about the details of that at about the 30-minute mark. So we're going to talk more about the details about that at about the 30-minute mark. Now, I'm going to share with you. I'm going to talk about the structure of the webinar in a second, but I've been having some conversations with some YouTube professionals, and they've been saying, Mark, don't do your announcements, get right to it, and you'll keep more people. But I just want to share with you some experiences I had last night. So Tuesday's my late night. I tend to have later appointments on Tuesday evenings, and last night was no exception. So Tuesday evening last night, but I had two appointments from folks I've talked to before that really made my day. I walked away from there, just really closed out the day nicely. And the one was a couple who we did a limited engagement for about 8 years ago. So they came to us with significant debt, and they said, geez, this debt is overwhelming. I know it's not something that you do all the time, but can you help us with this? And we developed a financial plan to help them pay off their debt. And then I didn't hear from them for a while until I saw them on my calendar for last night. And here we go, 8 years later, they're debt-free. They are, and they're preparing for retirement. So they've been paying attention now to the unique financial planning strategies we use and the tax efficient strategies. But boy, I was just so proud of those individuals, and I'm so glad to see that they worked through the plan and they got themselves out of a hole which really could have greatly affected their retirement. And then I had a phone call with a person from that I've talked to before, who told me they listen to the webinar all the time. They listen to the podcast, and she listed other podcasts, Ed Slott and Jeff Levine's podcast that I guess she learned from me, and some other things. And so she's a real dedicated listener and learner. She talked about books she had read, and she emails me once a year probably to ask me about books. But I was so impressed with the knowledge that she has, and just hearing the things that she was telling me that she's been doing for herself and her family. Very young person, I think 36 years old. But these comments about how much she's learned from the webinars and how much she's taken away, just really made my day. So Anne from Virginia, I know you might be listening. So I just want to give you a shout out and let you know that our conversation last night really, really made my day, as well as the other one I had. So I'll get back now to the programming. So our format is going to be today, as it nearly always is. We're going to go through some slot updates. I'm going to go over some market updates. So the big headline today is, of course, the government shutdown. We're going to talk about that. So that's going to last a couple of days, or maybe we're talking about this for a while. Who knows? But we're going to talk about what happened in the markets last week and some upcoming reports and expectations that we have. And then I'm going to get into the financial focus, which again, I'm going to talk about the new catch-up rules for certain retirement plans, who it affects, and what it means. So let's jump into the Slott Report here. Both of these are very interesting, and I'm going to share with you why. I'm going to share my screen so you can read along, and if you're just listening on the podcast, I'll do my best to read slowly and clearly for you. And if you want to jump in, if something interests you, you can come back to the video and read along with us. And of course, if you haven't already, please choose the subscribe, like, and notification buttons on the YouTube channel. And if you're loving the podcast, please share your podcast or share the podcast with people close to you. So this is another way to lose IRA bankruptcy protection for retirement accounts or IRAs. And this is from Ian Berger. And Ian writes, normally, if you declare bankruptcy, your IRA funds, traditional and Roth, are completely off limits for bankruptcy creditors. But a recent court decision is a good reminder that this isn't always the case. And I'll share with you that when we go to these training events, and I'll be in Austin, Texas with the Slott Group in November, one of my favorite part of the training and in the manual are the court decisions. but this is one example of something we see on a regular basis. So Ian continues to write. We're right here where it says bankruptcy protection. Ian writes, bankruptcy protection for IRAs comes from the Federal Bankruptcy Code. Under that law, up to $1,711,975 of annual IRA dollars are safe from bankruptcy creditors. This maximum amount is effective through March 31st, 2028. Importantly, the dollar limit does not take into account amounts you might roll over from company plans like 401ks. The rolled over plan dollars themselves are always fully protected under the bankruptcy code. This means only IRA contributions and their earnings count towards the $1,711,975 limit. Since IRAs did not become available until 1975, it would be unusual for someone to have amassed over $1.7 million from IRA contributions and earnings alone. So in most cases, no IRA funds will need to be turned over to creditors if you file for bankruptcy. However, there is one important exception to that rule. If your IRA loses its tax-exempt status, bankruptcy protection for that IRA disappears. When would this happen? The most common way is when a person in bankruptcy commits a prohibited transaction with his or her IRA dollars. Generally, a prohibited transaction is the improper use of IRA funds by the IRA owner, for example, through self-dealing. If you're in bankruptcy and have significant IRA assets, you can bet your creditors will scrutinize every one of your IRA transactions in order to claim prohibited transaction so they can seize your funds. So in a recent court decision from the Eastern District of Pennsylvania, very close to home here, illustrates another way that a person in bankruptcy can lose IRA creditor protection. In Stephanie Paula Farber versus Lynn E. Feldman, and then it gives the court docket, Stephanie Farber inherited her father's IRA worth about $41,000 in 2018. Farber used the $41,000 to open an IRA in her name at Wells Fargo. She subsequently rolled over the IRA to an individual retirement annuity with Allianz. The bankruptcy trustee, representing the creditors, contended that Farber funded her IRA with an amount that exceeded the annual IRA contribution limit in effect for 2018. That limit was $6,500. That's $5,500 plus a $1,000 catch-up for being over age 50 or older. That caused the IRA to lose its tax-exempt status, according to the trustee. The judge agreed. He found that although Farber didn't commit a prohibited transaction, she clearly made an excess contribution to her IRA. This prevented the IRA from being tax-exempt and prevented Farber from being able to shield those funds from her bankruptcy creditors. So one more page here. Farber had originally claimed that she had simply transferred over the inherited IRA to Wells Fargo and then to Allianz. She likely changed her story because if she truly had an inherited IRA, it would not be protected from bankruptcy creditors under the unanimous decision of the U.S. Supreme Court in Clark versus Ramaker. And again, gives the docket in 2014. So there are, a couple things glaring here. First of all, she took an inherited IRA and rolled it to her own IRA. That creates a problem. And then it really had nothing to do with it going to Allianz as an annuity. It really is the characteristic of the IRA that caused the problem for that instead of it being an inherited IRA. However, because it's an inherited IRA, or would have been an inherited IRA, it doesn't follow the same bankruptcy and creditor protection. And that's important to know because if you're leaving money to your loved ones and you're worried about that those funds being subject to creditor protection, inherited IRAs don't have that same creditor protection as your own. Okay. So next is IRA beneficiaries and Roth conversions. So, and this is the Slott Report mailbag. So this is from our friend Andy Ives. The first question here is, my father passed away in November 2021. I became disabled in April 2022. Am I now an eligible designated beneficiary that can use the stretch rule for distributions? I received disability payments, so the Social Security Administration knows my disability start date. I have read dozens of articles, all with conflicting information. Thank you for any advice. So this person wants to take advantage of the stretch option that's available. So that's taking distributions over your lifetime. Instead of having to distribute those funds in 10 years for an inherited IRA. and sometimes having to take required minimum distributions also during those 10 years. But for eligible designated beneficiaries, you have the option to stretch those payments over your lifetime. So the answer here is the status of an IRA beneficiary is determined on the day of death of the IRA owner. When your father passed away in November of 2021, you were not disabled. Consequently, you were a non-eligible designated beneficiary and are subject to the 10-year rule. Your beneficiary status as a non-eligible designated beneficiary is locked in for the IRA inherited from your father and cannot be changed. For that specific inherited IRA, you cannot reclassify yourself as an eligible designated beneficiary. However, as a disabled individual, you could qualify as an eligible designated beneficiary if you were to inherit another IRA in the future. So I think that was a really interesting question. Next question is, Andy, as a frequent reader of the mailbag and an occasional participant on some of Mr. Slott's webinars, I wanted to be sure I'm understanding your response to a mailbag question. This relates to the answer you gave to a September 11th, 2025 mailbag question regarding Roth conversions. The 67-year-old is planning annual Roth conversions prior to reaching RMD age, required minimum distribution age. You stated since you are over 59 and a half and have had a Roth IRA for 5 years, you never have to worry about another Roth 5-year clock again. This person writes, my home office, as well as multiple online sources, indicate that each conversion has its own 5-year clock, even if you are over age 59 and a half. So this tells me that this is a financial advisor. He says my home office, so this is a financial advisor probably working with a large organization, a large financial planning or financial advisory firm, and he's getting this information from his home office. So he's calling into whatever firm, talking to the experts, and they're telling him, no, there's a 5-year clock for every conversion, even if you're after 59 and a half. So what's the answer to this? The answer is based on the specific scenario in that September 11th, 2025 mailbag question, my response was accurate. The person was over age 59 and a half and had owned a Roth IRA for 5 years. As such, there would never be another 5-year conversion clock to worry about. But let's change the details. Assume a person is over age 59 and a half and never had a Roth IRA. In such a situation, that person would have to wait 5 years for the earnings on the conversion to be tax-free. It's important to recognize that each Roth conversion has its own details that must be considered. However, despite what many online sources indicate, I can say with 100% confidence and accuracy that once a person is over 59 and a half and has owned a Roth IRA for 5 years, there will never be another 5-year conversion clock to worry about. So that is a really good example. This, again, was obviously a financial advisor who asked this question, and obviously they were getting incorrect information. Under 59 and a half, there are, in fact, requirements for every conversion to have their own 5-year clock. Once you cross over 59 and a half, if you've had any Roth IRA for more than 5 years, even if you've only had $100 in that Roth IRA or less, I'm using $100,000 as arbitrary amounts, a small amount, then you've met your requirements for the 5-year clock. But there are just multitudes and many, many people who do what we do and don't understand these rules. So I wish for them to all join the Slott group, go to the semi-annual trainings, read these updates that are available all the time. We get updates on a regular basis and learn the details. Okay, so moving on, let's talk about the market. So our chief investment officer writes for us that markets ended slightly overall last week. This is for the week ending September 26, 2025. So markets ended slightly lower overall, but the U.S. economy continues to show some resilience. Last week, we saw stronger gross domestic product, consumer spending, housing, and durable goods data, though inflation remains sticky above the Fed's 2% target. The Commerce Department revised second quarter gross domestic product growth upward to 3.8% annualized, up from the previous estimate of 3.3%. Consumer spending held up strongly in August with personal consumer consumption expenditures, or PCE, up 0.6% month over month. Personal income increased by 4.4%. Boy, that would be a big increase, 4%. Personal income increased by 0.4% in August, with disposable personal income after taxes rising similarly. These data points suggest that the consumer remains resilient despite inflationary pressures and policy uncertainty. The Personal Consumption Expenditures Index, or the PCE, came in at 2.7% year over year, up from 2.6% the month before. So that's what the Fed seems to pay attention to, is this PCE index. And then the core PCE that excludes food and energy held at 2.9%, still above the Fed's 2% target. We saw the September employment report, which will be a key data point for the Fed's next meeting in October. So the big headline, of course, is as of 12:01 this morning, we're in a government shutdown. So historically, shutdowns of a few days have limited economic impact. Prolonged shutdowns can be much more substantial. We're likely not to see accurate data over the next few days or while the shutdown is happening for certain reports, but we'll see what happens with this. So what do we have coming up on the week ahead? So yesterday we had the Consumer Confidence Index showed a decline. So Consumer Confidence Index, how people are feeling about the economy and the overall economic feeling of the nation. That's coming in at a 96.0, which was below the previous month at 97.4, suggesting a modest dip in consumer sentiment. Yesterday, we also saw, that was on Monday. Yesterday, Tuesday, we saw the Consumer Price Index for August came in at 2.9%, which was in line with estimates, but above July's number at 2.7%. The core CPI, excluding food and energy, was 3.1%. We have this JOLTS report, and that stands for Job Openings and Labor Turnover Survey. For August, that showed that openings, firings, quits, and layoffs were all little change, suggesting a cooling in the labor market rather than a deterioration. Today, we're expecting unemployment information and construction spending, but again, with the shutdown, these reports may be delayed. And that's it for reports. So what are the firms saying? I'd like to compare different views. On the positive side, we have JP Morgan. They anticipate global equities, that global stocks will outperform fixed income. Fixed income is bonds. So they're saying stocks will outperform bonds in the next quarter, driven by artificial intelligence momentum and expected interest rate cuts. Goldman Sachs is saying they're forecasting solid global economic growth in 2025 despite trade uncertainties. Barclays remains optimistic about global stocks, citing strong U.S. consumer spending and AI-driven tech earnings. So who's on the negative side? Well, Morgan Stanley is warning of widespread global economic deceleration, forecasting a slowdown in gross domestic product in 2025 and 2026, primarily due to higher tariffs. Wells Fargo highlights tariffs as a pressure point on U.S. economic growth in the near term, though it anticipates that lower interest rates will support the economy later this year. So as I always say, when the big guns can't decide which way they think things are going to go, what's your answer here? How do little old us make these decisions? And the answer is have your financial plan drive your investment decisions. Use the fundamentals and the principles of asset allocation, principal protection, and account segmentation. But most importantly, have your financial plan drive those investment decisions. Okay, so let's look at some details about the market last week. So the Dow Jones Industrial Average was down just 0.15%. The largest drop we saw was it looks like the emerging markets. So that was down negative 1.2. Just really slightly down across the board. Small companies, global small companies were down just over 1%. But the thing is, the bond market was also down. So remember, we're sold a lot that bonds will increase when stocks decrease, and bonds decrease when stocks increase. One zigs when the other zags, whatever term somebody's using. But there are many times that we see the same direction in the bond market and the stock market. And the stock market is up very, very strongly this year. So year-to-date numbers, the Dow Jones Industrial Average is up over 10%. The S&P 500 is up over 14%. The NASDAQ is up over 17%. The MSCI World Index, which is all the large global companies that aren't in the U.S., is up over 24%, over 24.5%. Emerging markets for the year is up over 26%. So very, very strong. Bond markets for the year, the U.S. aggregate bond market is up 5.9%. So that's maturities of about 7 to 9 years. You've heard me say that's where most people seem to have their bond money. And even short-term bonds are up 4.05%. So we're seeing great growth on both sides, but we're also seeing, last week was a drop on both sides. So this is the financial focus portion of our weekly webinar. This is usually the last half hour or so, and we explore a financial planning topic. Today, our topic is going to be retirement plan catch-up rules that are changing in January of 2026. So today, sitting here, it is October 1st, 2025. This big change in retirement plan contributions and catch-up levels has been, this train's been coming for a while, and we're going to talk about some of the delays that have happened, air quote, delays that have happened, and who this affects, what catch-up contributions are, and what plans they affect, and how it might affect you. So I'm going to share my screen here. I've got a whiteboard here that we're going to use to follow. So let's give a little bit of history here. This all started back in 2023 when the Secure 2.0 Act was passed, and it made a change in the plan, or a change in the tax law, that said catch-up contributions for highly paid employees must be paid into Roth retirement plans. So we're specifically here talking about 401ks, 403b plans, and 457 governmental plans. So if you don't know what a 457 governmental plan is, then you probably don't have one. So they're very specific, obviously, to government plans, but 403b plans tend to act like 401ks with some nuanced differences, and they tend to be for not-for-profits, school districts, other organizations like that. But most people have their money in 401k plans, and everybody kind of knows what a 401k plan is. It's an ability to have your payroll deduction placed into a savings account to be used for retirement savings. And most people still put their money into the traditional side of the 401ks, and that is where you're not taxed on the money that goes into the 401k, but you're taxed when the money comes out, and any growth, of course, on that. So that's a traditional 401k, and then many plans now, and there's it's about 93% of 401k plans now offer a Roth option. So there are more and more people contributing to the Roth option of their 401k. But this plan here said, this change in the tax law from 2023 said, everybody who is a highly paid individual, and we'll talk about that, but I'll touch on it. And that means anybody earning $145,000 in W-2 wages in 2020, in this year, would have to make their catch-up contributions into the Roth option of the 401k. So let's talk about catch-up contributions. Oh, and here's a quote from the Ed Slott & Company Elite Training Manual from May 2025. So that was the last live update that we had with, again, we attend these training courses, and we go through tax law changes and things like this. So in the manual, it reads, the Roth catch-up requirement for employees whose prior year wages exceeded a dollar threshold is the only mandatory Roth feature in Secure 2.0, and the first mandatory Roth provision ever added to the tax code. So it's an important piece of legislation, and we should pay attention to it, because there's been discussion year over year about adding Roth requirements to the tax code. There was a whole Rothification a few years ago. I think it was when they were discussing the first Secure Act, that they wanted to limit the amount that anybody put into a 401k, traditional 401k, and that money would have to go into a Roth. And I talked about what a traditional 401k is. Again, you get a payroll deduction that you don't pay tax on that goes into your 401k, and you don't pay tax on it when it goes in, but you pay tax on any distributions that come out and the growth of those distributions. On the other hand, Roth, you pay tax on that money that goes into the Roth IRA, whether you contribute it or whether your employer contributes it, and then you don't pay tax on it now, but you do pay tax on it now. You pay tax on the contribution, and then you don't pay tax on the amount that you put in or any growth. So that's the difference. And the IRS talks about this as the seed or the harvest. So a traditional IRA, you pay tax on the harvest, not the seed. With the Roth IRA, you pay tax on the seed, but not the harvest. So that helps people think about the differences. So this is important. The first mandatory Roth provision ever added to the tax code. So what's a catch-up contribution? We'll come over here. We're going to focus on 401ks and 403bs here. And this form is available on our website. If you go to attleborowealth.com, I'm just going to show that for a second. That's attleborowealth.com. You can go over to the slot corner, scroll down to the bottom, and there's a download section, and you can download this form and several others that have to do with tax planning and retirement plan contributions, etc. So in 2025, let's focus on 2025. A regular contribution for anybody under 50 years old is $23,500. And then we have these catch-up contributions. So this catch-up contribution for those over 50 years old and not yet 60 years old can make an additional $7,500 in catch-up contribution. And also if you're over 63 years old, so 64 and older, your catch-up contribution is $7,500. Because Congress likes to make things difficult, once you cross over 64 years old again, your catch-up contribution drops back down to $7,500. But in a window, you'll see here, of 60 years old, 61, 62, or 63, this catch-up contribution jumps up to $11,250. So these catch-up contributions that we're talking about are either going to be $7,500 or $11,250, dependent on age. And this is the amount that we're talking about. So in the past, if we have our buckets here, so if you've got your taxable bucket, and these are, let's just for simplicity, let's say that these are funds held that are outside retirement plans or IRAs, traditional IRAs. You've got your tax deferred bucket, and these are your traditional IRAs. So I'm just going to put traditional here. Traditional IRAs, traditional 401ks, traditional 403bs, any traditional retirement. And then you've got your tax advantaged bucket. And here we're talking about Roth. Anything Roth, whether it's a 401k or other 401k, 403b. There's even Roth SEP plans, Roth 457 plans. But specifically in this legislation, we're talking about Roth 401ks, Roth 403b plans, and governmental 457 plans. Non-governmental 457 plans don't apply. So I'm just gonna be clear here. So 403b and 457b plans, but government 457 plans. So in the past, you could make your own. So we've got your let's just call it regular contributions into the tax deferred bucket, and your catch-up contributions into the tax deferred bucket. Starting in January 2026, if your income is greater than $145,000 in wages, W-2 wages self-employed income doesn't count. That was clarified. But if you're greater than $145,000 in W-2 wages, then you don't have the option of the money going into this tax deferred section of your 401k anymore. You've got to put the money into the Roth option of your 401k, 403b, or 457 plan. So that's the new rule. All right. And that starts January 1st, 2026, most of the time. And I'm going to talk about that in a second. So let's come back here. So that's what a catch-up contribution is, and that's the nature of the law change. So instead of it going into your tax-deferred bucket, that catch-up part, your own, let me come back. I'm sorry to keep going back and forth. But again, your own regular contribution can still go into the tax-deferred. That doesn't change. What changes is the catch-up contribution. And the catch-up contribution, depending on your age, is either going to be $7,500 or $11,250. And you can, if you're not sure what your catch-up is, again, you can go to our website, download this form, and you'll see if you're greater than 50, but not yet 60, it's going to be $7,500. If you're 60 years old, 61, 62, or 63, then your catch-up can be $11,250 instead of $7,500, not on top of it, but instead of. But once you turn 64, you're back to the $7,500. And I know it's crazy, right? You're a congressperson. Okay, so we talked about the effective date of January 2026, but remember, this Secure Act happened all the way back in 2023. Well, the first effective date for this was December 31st of 2025. So that would be first effective date was 2023. That was January 1st, 2024 for most plans. So what happens, though, is that the administrators and the regulators look at this and say, wait a minute, this is a really big lift for these plans. Because first of all, not every plan has a Roth option. Not every 401k, 403b, or 457b plan, a governmental 457 plan has a Roth option. So that was a question too. What happens if there's no Roth option? And does everybody have to have a Roth option in place? And how are we going to operationally make this happen? So they asked for a delay. Well, now the only organization that can delay legislation is Congress. So it's a delay, but it's not really a delay. There was an administrative transition period, and that administrative transition period is 2024 and 2025. So we got a delay, but it's not really a delay. It's an administrative transition period, and that covered us for 2024 through 2025. Then we have proposed regulations. Proposed regulations say this is how that's going to spell out, and they're the regulations until the final regulations come out. Well, we got the final regulations on September 15th of 2025. The final regulations said retirement plans must comply by January 1st of 2026, maybe. And we'll talk about the maybe in a second. And again, what type of plans must comply? 401k plans, 403b plans, and governmental 457b plans. Who does it affect? Highly paid employees, someone earning more than $145,000 in 2025 in W-2 wages indexed for inflation. So that'll increase every year from your current employer using prior year's numbers. So this is where it gets a little confusing. If you let's just say I work for XYZ company in 2025, and I go to ABC company in 2026. Well, I don't have any prior year earnings for my current employer, so I actually would not fall into the requirement. And if I made more than $145,000, if I triggered the highly paid employee requirement, and if I had a new job, didn't have prior year earnings for that company, then I would not have to make my catch-up contributions into the Roth. Now, listen, I'm not going to have a discussion broadly about if it makes sense to contribute to the traditional side or the Roth side, whichever is better. That's very, very individualized. And if you want to have that discussion, we can have that discussion. You can send me a question, or if you have more than $1 million of invested assets, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com, or schedule time with me on our website at attleborowealth.com. So those questions are very, very individualized. The objective here is to give you broad brush, some education on these changes that you should be paying attention to. So so we know what type of plans it affects. We know when it's in effect, and I'll come back to the maybe. We have so the types of plans: 401k, 403b plans, governmental 457 plans. It affects highly paid employees. That the definition of that is someone earning more than $145,000 in this year. It'll be indexed for inflations. It affects your current employer with prior year wages. So you understand there could be a kind of a donut hole or a loophole here where if you change employers, you don't have to make the contribution to your catch-up contribution to your Roth IRA. I expect that, there's surely going to be a lot of people that's going to apply to, and we're going to see a lot of questions, but most people, their employer is going to be year after year, so that you're going to see the prior year for a current employer being the requirement most of the time. But what about retirement plans with no Roth option? This is a big deal. Now it's less of a big deal than it was, when I started focusing on tax planning back in 2012. It seemed like, I don't know the number of plans that had Roth options then. It seemed like there was probably about 50%. We had about a 50-50 chance of a plan saying, yes, we offer Roth options. Well, today, about 93% of plans have Roth options. But what happens if you have a plan, you work for a company that doesn't have a Roth option? What happens? Well, the legislation doesn't say, well, you must have a Roth option. But what happens is no catch-up contributions are allowed for highly paid employees. So if suddenly your highest paid employees can't make those extra contributions, $7,500, $11,250, whichever one it is, then you're going to get some pressure from those employees to say, well, wait a minute, why don't we just set up a Roth option? It's a pretty simple process to set up that Roth option. So you're going to see this number probably go very, very close to 100% very, very shortly. So that's the issue with that. Okay, so now what about this maybe? Okay, we've got to comply maybe. So follow me over here. I posted a couple things. I thought this was really interesting. So this was, there's a lot of articles, and one of the reasons I wanted to share this with you today is there's a lot of information I'm seeing about this in different articles. And Fortune took this tact on their headline because they're good headliners. Peter Thiel's $5 billion tax-free account spurred a new 401k rule that now impacts high-earning Americans over 50. Now, that might be true. I'm not sure. There was some motivation from a senator at the time who said, we've got to make some changes to 401k contributions and give people the opportunity to do that. I'm not sure if there's a direct line between the $5 billion Roth IRA that Peter Thiel has and this 401k, but it would be interesting to dig into that a little bit. But this article talks about what's changing, who's impacted, and then we have this article I shared with you last week on our webinar from the Slott Group, and it talks about the IRS confirms the effective date of mandatory Roth catch-up rule Monday. That was from Monday, September 22nd, so last week. So on September 15th, we saw the final regulations, and again, the mandatory Roth catch-up rule is effective January 1st, 2026. And it talks more about who this applies to. Read right here with me. The IRS did extend the effective date of its final regulations interpreting the new law until January 1st, 2027. The IRS's decision to delay the effective date of its regulations has led some people to conclude that plans don't have to comply with the law itself until 2027. So this is where we're going to see people try to get tricky, and we're going to see some tax law updates maybe 2, 3, 5 years from now in our slot updates that are going to point back to this because people are already saying, well, wait a minute, there's this maybe clause. That means we actually don't have to do this until 2027. Because like I said, this train's been coming for a while. But these plan providers, this is a big ship to move. And I'm sure they're scrambling right now still to get ready for this January 2026 requirement. So let me read that last bit again. The IRS's decision, I'm right here. The IRS's decision to delay the effective date of its regulations has led some people to conclude that plans don't have to comply with the law itself until 2027. That is incorrect. Plans do have to comply with the Roth catch-up law starting in 2026. It's just that during 2026, plans have more leeway in how they apply the law and don't necessarily have to follow the IRS's guidance. So it's, again, these are big ships to move. There's a little bit of a maybe clause in here. I expect that we're going to see some people trying to circumvent it, and we'll just have to see how it works out in the end. But the requirement is January 1st, 2026. There's a bit of an exclusion for January 1st, 2027. All right, let's come back to our beginning here. Okay, so those are the updates for the retirement plan catch-up contribution changes that will be effective January 1st, 2026 for some people, for some plans. And again, those some people are highly paid employees with W-2 wages over $145,000 that will be indexed for inflation. And the plans will be 401k plans, 403b plans, and governmental 457 plans. I hope that information was helpful. Let me just jump back to our announcements now. So our announcements. So we've got some upcoming events. We have an encore class that we just scheduled for November 13th and November 20th. So that's a 2-class series. You have to attend both classes, 3 hours apiece. That will be at Mercer County Community College. Again, we had a huge amount of people that wanted to come to the first series of classes that we had, but we couldn't accommodate everybody. We tried to host some folks during Zoom. We were successful with some, but we had another group of people that we tried to accommodate, and we got it done. So that'll be November 13th and November 20th. 2-class series starting at 6:30, ending at 9:30 on both nights. We hosted the Psychology of Retirement at the Newtown Theater last Thursday. That was a lot of fun. We had a great showing. 80 some people came out to watch that movie. That's based on Morgan Housel is really the driver behind this, and he wrote a great book, The Psychology of Money, and The Psychology of Retirement is a very good movie. If you haven't seen it, I suggest you do. And we're working on a special event here at our location, at our office on October 30th. As part of our Attleboro Wealth Gives Back initiatives, and I'm going to give you some more information as we get closer to that. So we should know more next week. So I hope to have some updates for you next week. I think it could be a lot of fun and very beneficial to you. If you're close by, you can come out. So I hope that was helpful today. Feel free to share this information with those close to you. And if you haven't already, hit the like, subscribe, and notification buttons, and share our podcast if you like it. We'll see you next week, and have a great week. Take care. Bye-bye.